In the news, Wall Street says the stock markets are affected by Bitcoin's volatility. Yet, why are two of the three top worries for mainstream investors right now A, a crash in the global bond markets, and B, mistakes in monetary policy by the Federal Reserve in the United States or the European Central Bank? So why are 49% of all the investors' fears based on bonds and central policy moving into 2018? Maybe it's because Goldman Sachs is warning that current market valuations for these traditional financial markets are at the highest valuations since 1900. The risk scenario that Goldman Sachs sees is an inflation jump that ushers what they're referring to as fast pain. Let's talk about that. In possible unrelated news, Goldman Sachs pivots and is set to offer cryptocurrency trading in 2018. Let's discuss. Hey everybody, I'm Gary Palmer Jr., you're you, and together we are Minting Coins, your trusted source for crypto news, interviews, and ICO reviews. If you are new or not, tap that like button, subscribe to the show to show your support. It helps other people find this content, and also leave your questions and comments as you have them in the comments box below, so your voice is heard as part of this community. In this video, we're going to be talking about the markets, we're going to be talking about the bond markets, we're going to be talking about what's happening in the world of Wells Fargo, Goldman Sachs, and what Bloomberg is saying about news in our industry. So with that being said, why don't we immediately just take a quick peek at the market, go over the news, and then let's discuss. I want to give a special thank you to Dan. Dan, thank you for watching. Thank you for supporting the channel. And to give Dan a shout out, Dan is running this Telegram channel. This Telegram channel is t.me/whaletank. This is the whale tank for crypto. Over 7,200 members. So there's definitely a healthy number of people who are in this room learning, getting information. What the whale tank is all about and what Dan is doing is that they are providing ultimate cryptocurrency signals. So they're providing educated signals based on their news, their tips, their tweets, all included with this group, helping people make up to 400% on a single trade. And so Dan and his team are a group of highly experienced and highly professional traders, and they advertise in their group that they're helping people with average signal profits of 25%. So, you know, there's ups and there's downs with trading in any market. And in this market, Dan is providing people educated tips and helping people to improve their trading game. So if this is something that you're interested in, this group, feel free to click on the link in the comments box below and take a look at it. If this is a great group, if you're getting value out of this group, then feel free to let us know and help educate us how the whale tank is helping you in your trading every day. So real quick, we're living in a world where the total market capitalization of all the different cryptocurrencies in the world is $595 billion. Bitcoin dominance is 37%. So the total Bitcoin market capitalization from the total $595 billion is $224 billion, giving us a per Bitcoin price of $13,300. There's currently still 16.7 million Bitcoins in circulation, less than that when we consider the ones that are lost and the ones that Satoshi isn't using. And just a lot of coins, a lot of movement across all these other, you know, top 10 coins and other cryptocurrencies in the top market space. We see a lot of money flowing into the cryptocurrency space and then flowing through Bitcoin and Ethereum and then into a lot of these other ERC20 tokens and other blockchain projects. Some money sometimes does get pulled out in a USD. The whole market could crash. But overall, what we've been seeing over the course of the past 9 or 10 years is just this breathing in, breathing up of the Bitcoin protocol, the usage of the technology, let it be on the mining side or the purchasing of the token side, it's definitely moving in this upward trajectory. Every time it reaches a new high, there's a pullback, and then the market goes headfirst back into Bitcoin. And it's going to be really interesting to see how many days it takes to get Bitcoin up to that $20,000 mark where it was in Q4 2017. And yeah, it's going to be really interesting indeed. I think the past 200-day moving average is about $4,000 or so, and we are at still all-time highs. Bitcoin could crash thousands and thousands and thousands of dollars, and the Bitcoin overall value would still be just as strong as it's ever been in the past 200 days. But what's going on here? A lot of people are wondering what's happening in this world of Bitcoin, what's happening in the world that we live in. We're not talking about it in this video, but we have the Chinese oil markets, which are set to really take a lot of attention and a lot of trading away from the US petrodollar for this petro yuan, petro renminbi. And that's going to be really interesting. We'll be talking about that in an up and coming video. But with the Bitcoin space and this relationship with the fiat, we looked at this meme in a previous video, but a lot of people wondering, is Bitcoin a bubble? Are we in a bubble in the cryptocurrency space? And what Homer Simpson is recognizing in this meme here is that Bitcoin is not a bubble. It is a measure of the collapse of the fiat currency. And a collapse of the fiat currency is definitely, perhaps at least at this point, maybe a little hyperbolic. Maybe it's not. That remains to be seen. But what we are seeing is that there is some cause for concern, as we are hearing from industry leaders and market regulators, and we're going to be seeing that in this video here. So first off, what we want to touch upon is that we have this one article that came out of the Cointelegraph that was speaking about Wells Fargo and the stock market's ability to be affected by the Bitcoin volatility. And so we have Wells Fargo head of equity strategy, Chris Harvey, who said the technology companies and equities could well feel the effects of further corrections going into 2018, because there's a lot of companies inside the stock market that are affected by the Bitcoin industry. There's also trading that's happening in a market, and the trading that's going into Bitcoin is definitely trading that's not going into what would otherwise be stocks. Anyway, the head of equity strategy, Chris Harvey, goes on to say that people have been asking me about the speculation in the crypto market, and there's a significant amount of froth. We think that it will come out and spill over. It's not going to happen in a vacuum, and you're seeing technology down. Not a lot, but a little bit. And so anyway, Harvey cautioned that the stocks would bear the brunt of further volatility, adding that at the end of the day, what we're worried about is the froth coming out of that market and starting to affect the equities. And so we're seeing a little bit, but not to a large degree, and it's something to watch out for 2018. And so this is something that they're looking at. This is something that they're pointing to. Wells Fargo is just recognizing that Bitcoin is affecting the volatility of the stock markets as it's affecting other different companies in the space. And also, as there's speculation going into Bitcoin, that spillover could take away from the equities, take away from the fiat, take away from these stocks and these bonds going into the cryptocurrencies, which do not have a central authority, that in a lot of cases are utilizing scarce tokens, which will never increase in terms of the total number of supply set to increase by the math of that blockchain technology. In the case of Bitcoin, it's never going to be more than 21 million. There's 16.7 million Bitcoin right now, and it's going to take over 100 years for us to see the full 21 million of Bitcoin ever even materialize in the first place. But separate from the stock market, we have something very important, and what that is the bond market. And so what we have in this article over here from CNBC coming out is that the bond market crash is a growing worry for investors. And so what we see is that there's this survey that was sent out to the Bank of America Merrill Lynch's November Global Fund Manager Survey. And from the survey, 22% of respondents said that their greatest worry is a sharp drop in the bonds, and it's the biggest risk that people have to worry about in the market. So these findings are coming just as key global bond yields have climbed to multi-year highs in the last few days. And if we see further weakening in the bond markets, particularly the credit bond markets or the corporate bond markets, it's going to have a negative impact on the stock markets. And this is coming from Michael Hartnett, who's the chief investment strategist at the Bank of America Merrill Lynch. And that's what he was saying to CNBC in a phone interview on Tuesday. And so just to reiterate, while Wells Fargo in the previous piece of news was saying that the stock market can be, is, and will be affected by Bitcoin's volatility, we're seeing here from CNBC, unrelated to cryptocurrency, that traditional investors who are at least customers from the Bank of America Merrill Lynch are really worried about the crash of the credit bond market affecting the stock market. And so let's dive in to see a little bit deeper about what's going on over here. There's three different worries that they're worried about. 27% of the respondents are fearing a mistake in monetary policy from the Federal Reserve or the European central banks. The second largest issue is that people are worried about, 22% of these respondents are worried about a huge risk of the sharp drop into bonds. And this is followed by 13% who were most worried about a market structure generated crash. Other concerns that are on the list, North Korea, which has decreased significantly from the month before. A NASDAQ bubble has appeared on the list, so people are starting to wonder if NASDAQ is in a bubble. Very, very interesting. Or something else that could potentially happen. And so, again, what Michael Hartnett goes on to say is that if we see further weakening in the bond markets, particularly the credit bond markets or corporate bond markets, it's going to have a negative impact on the stock markets. And so if you're paying attention, this is just something to look out for. Every time that there's been closing in of these different types of bonds, it's always been followed by a recession to varying degrees. And so the U.S. 2-year Treasury yield traded Tuesday at near 1.69%, near its highest valuation since October 21st, 2008. And then the benchmark U.S. 10-year Treasury yield, which is used to compare and contrast that these different bonds on these different bond prices, was 2.38%. And so this is the closest percentage that these two have been in quite some time. And it's definitely a cause for concern that people are recognizing all across the market, mostly outside of cryptocurrency. But if you have cryptocurrency in your rear view mirror, your side view mirror, right in front of you, your peripheral, you're going to recognize that the cryptocurrency is going to be a source for people to focus either a percentage of their portfolios or an exit option for the options that are available for the people who know about the options, for people that set themselves up to take advantage of their options. Those are the people that have options. Anyone else who just gets with the program, goes with the flow, and just happens to do whatever they're told to do, those are the people who are going to get churned out through the machine and the tides and the shifts of change, which could be coming if what the people over here at CNBC and Bank of America Merrill Lynch come true, like what they're saying. So the top worry from July to September last year was actually that the GOP was going to win the White House. And the response from that is that the stock market plunged that election night, but quickly recovered, and the stock market has been surging to all-time highs ever since. A year later, people are worried that there's a bubble in the NASDAQ, and that's about 8% of the respondents or so. There's no fear of the Fed, none. And until there is, it's going to be difficult for the markets to go down in a big way. The catalyst has to be inflation, especially wage inflation. And so what Hartnett is going on to say here is that there's no fear of the Fed. There's no fear that the Fed is going to do anything rash, and no one is going to be worried. The markets are not going to react. The markets are not going to go down unless the Fed does something that the markets aren't expecting, or unless the Fed does something that the markets don't like. If the Fed does something that is either unexpected or negative toward the markets, then what we're seeing is a possible difficult situation that could happen, that could affect the stock markets, that could bring the stock markets lower and remove us in the opposite direction from these all-time highs the stock markets have been in. And so to further emphasize here, what Harnett is saying would be the inflation of the Federal Reserve taking more drastic action. That catalyst would be inflation of the dollar, which would not affect the face value of the dollar, not affect the face value of the Benjamins, but those Benjamins would have less buying power than they do now if and when the inflation hits your currency. And so he's saying when inflation hits, the Fed is going to take actions to go against the inflation to help, protect the nation from the inflation allegedly. And then if the Fed takes those actions, then the stock market will react negatively. And this is sort of being foreshadowed with the bond markets. And that's what I'm seeing in this article and how I'm reading this article. Feel free to let me know what you think in the comments below. That was CNBC. So we talked about Wells Fargo related to crypto. We talked about CNBC and Bank of America Merrill Lynch and related to the inflation and related to the bond markets. And now here we have an article from Bloomberg that's talking about information coming from Goldman Sachs. And so Goldman is warning that market valuations are currently the highest they've ever been since the year 1900. The returns are likely to be lower across all assets in the medium term. So short term, who knows, probably good, probably great, probably okay. In the medium term, they're saying that the returns are going to be lower. And long term, it's going to be really difficult to see what happens because there's no way that anybody can know. Previous article, we're seeing about that risk of inflation potentially hitting the Fed. And so this risk scenario of Goldman Sachs actually does see that the inflation jumps and then that ushers in what they're calling fast pain. What this note from this analyst comes in and it says all good things must come to an end. And they go on to say that there will be a bear market, eventually. And so they're not saying that it's going to be here in 2018, although the bond prices don't look good, and the bond prices definitely indicate that good things on the horizon, we'll put it like that. And this analyst is saying that the bear market is definitely coming and that all good things must come to an end. So this is what Goldman Sachs is saying. And so additionally, as the central banks are cutting back on their quantitative easing, which means how much the banks are purchasing into companies and stocks and bonds, they're saying that the returns are likely going to be lower across all asset classes. A second, less likely scenario would involve fast pain, and stock and bond valuations would both get hit, as we've been seeing. That's a general theme going on in this video here. And this would get triggered depending on whether the trigger involved either a negative growth shock or a growth shock alongside an inflation pickup. And so then we get into a lot of information. We're not going to go deep into these charts and graphs and a lot of this other information, but this is just going on into the valuations, the frustrations from the bonds and the equities appearing, expensive and in flux when they compare the Shiller PE index versus the US 10-year and the BAA AAA credit spread. And so it's really interesting when you go in there, you dive into that, you see that information. Definitely check out this article, do your own research, and just sort of recognize if good things could be on the horizon, if bad things could be on the horizon, and definitely make preparations for yourself accordingly. One, or at least one other that we're going to go over, key findings in this report include the fact that central banks might be willing or able to buffer the growth or inflation shocks, especially if they judge that the imbalances are in excess of building. They also face fewer options to ease the monetary policy given the low rates and the big balance sheets. And so again, to reiterate here, what is this saying? This is saying that the central banks have huge amounts of debt on their balance sheets. The central banks don't have a lot of options because the rates are already very, very low. And because of this, if it's a really difficult situation to manage, the central banks may not be willing or able to offer their assistance. It really creates a really sort of drastic scenario of the future, which a lot of people can get placed in a really difficult situation, especially if those people don't have options or alternatives, as we've been seeing people in Zimbabwe, people in Venezuela, people in Greece, people all over the place who have really been depending on alternative forms of digital assets, currencies, communications in times of, really difficult maneuvering, both financially, technologically, politically. And to some degree, the great upward trend of our stock market and the growth in the United States economy, the world economy, the economy across Europe could be affected. And when that happens, there may not be a lot of options. And when that happens, a lot of people may see cryptocurrency as an alternative. And if they do, could there be a rush of people's fiat currency into Bitcoin, into Litecoin, into Ethereum? It seems to be a definite possibility. If and when that happens, will there be capital controls? Will there be restrictions? Will there be new laws, new rules, new regulations for the newcomers who haven't already gotten a chance to get into the Bitcoin and blockchain technology space? All of it remains to be seen. Nobody can say for certain. But while Goldman Sachs has traditionally been against Bitcoin and cryptocurrency, they're now giving these reports that are saying there's difficult times on the horizon. Goldman Sachs is now set to offer cryptocurrency trading in their future, pivoting before whatever happens comes to fruition. Goldman Sachs is becoming one of the first large banks in the United States to embrace Bitcoin and other cryptocurrencies. And as the bank is currently building a team to tackle many of the issues that will come from implementing the trading, they're going to have all sorts of additional issues figuring out how to control those assets, how to secure those assets, because as those banks have to hold Bitcoin to run these new financial systems that they're going to be offering, they're going to be subject to their Bitcoin getting hacked, because that's going to be a giant piggy bank for someone to take advantage of. So with that being said, that's going to create new risks for these banks, new rewards for these banks. It's also going to create new demand for Bitcoin and for blockchain technology, as both the banks are going to be seeking to increase their Bitcoin and blockchain position, and they're going to be opening up the market to a lot of additional capital to then purchase Bitcoin to drive that price up, especially in a world where the number of Bitcoins are totally limited, and the demand may increase as the scarcity will surely decrease. Yeah, so it's really interesting to note that as this happens, a lot of people are wary, but at the same time, this adds a lot of legitimacy to Bitcoin. This adds a lot of legitimacy to the technology, and this creates additional entry points for a lot of additional people to move into the space. Other currencies have already been applied in many real cases worldwide, and some countries have already announced their plans to launch their own state-sponsored digital payment systems. This is happening in Russia. This is happening in countries across Europe. We're going to see this in countries across Asia. And only a matter of time before we see a Fed coin or a Fed note in the United States, which will simply allow the US dollar to be traded just as fast as Bitcoin. It's going to allow the US dollar to reconcile just as fast as Bitcoin, but it's going to give the government the ability to control the monetary policy, to print more Fed coins of these federal, crypto US dollars. And then it's also going to give them insights about where those dollars are being sent, being able to shut off people's access to send or receive those dollars. Definitely a huge contrast to Bitcoin. So it's comparable in some ways, but it's completely different in other ways. The point is that people are moving in the direction of Bitcoin, blockchain technology, cryptocurrencies technology, and this push in this direction toward blockchain technology, could that get accelerated if and when there's a market correction? Could that get accelerated when people are spooked and when the US dollar decreases in value because things that may or may not happen in the market? All of it remains to be seen. I would love to know, what do you think is going to happen? What do you think about the bond markets? What do you think about the stock markets? And do you think that the stock market will continue to accelerate forever? Or do you think that, perhaps a correction is coming? How will that affect cryptocurrency? And what are you doing to prepare? Are you getting yourself, if you don't already have a Bitcoin wallet, are you considering getting a Bitcoin wallet, or are you going to be sitting on the sidelines a little bit more? If you're going to be sitting on the sidelines a little bit more, what are you waiting for? What questions do you have? What's holding you back from making the decision to just throw $5 in? Thank you for watching this content and learning about this information with me. Don't forget to tap that like button and subscribe. It encourages us so much and it helps other people find this content. Also, if you're interested in behind-the-scenes access, special rewards, and a direct connection with me and our crypto community, then become our patron at patreon.com/mintingcoins or via our website at mintingcoins.com/join. We look forward to connecting with you because together, we are minting coins.